Commerzbank just published their analysis of gold's recent volatility. Their conclusion, gold dropped to 4,900 due to technical and flow factors rather than any clear macro trigger. Expect consolidation. Markets haven't settled down yet from late January turmoil. That's the institutional narrative. Technical volatility, no fundamental reason, just wait for things to calm down, and it's complete nonsense. What Commerzbank is calling volatility is actually the clearest accumulation pattern we've seen in months. What they're calling consolidation is institutional buying happening in size, while retail panics over headlines. Today I'm going to break down what actually happened, why Commerzbank's analysis misses the entire point, and what this price action is really telling us about the next major move. Let's get into it. First, let's establish what happened according to Commerzbank's timeline. Gold and silver came under significant pressure yesterday. Gold slipped to 4,900 per ounce. Silver touched 75. Then prices stabilized near 5,000 for gold, 77 for silver. Commerzbank attributes this to technical and flow factors rather than a clear macro trigger. Let me translate that into plain English. Technical factors means the chart looked overbought, traders took profits, algorithms sold, stops got triggered. Flow factors means large orders came through, probably some institutional rebalancing or hedge fund position adjustments. Not a clear macro trigger means we can't point to a specific news event that caused the selling, so we're calling it random volatility. And then they add this critical detail. Chinese participants are absent during New Year holidays. This is the most important sentence in their entire analysis, and they bury it like it's a footnote. China, the world's largest gold buyer, the country that just revealed 14,000 tons of reserves, the nation driving the structural bid under gold, is not in the market. And Commerzbank thinks that's irrelevant context for understanding why gold dropped. That's not analysis, that's willful blindness. Let me show you what actually happened and why it matters. Gold was trading around 5,100, strong, consolidating above 5,000, building a base for the next leg higher, then selling pressure hit, not panic selling, systematic algorithmic selling, the kind that shows up as large blocks moving through the market in regular intervals. Gold dropped from 5,100 to 50,000, then 4,950, then 4,900. At 4,900, the selling stopped. Buyers stepped in, prices stabilized and climbed back toward 5,000. Now ask yourself, what kind of event creates that pattern? Random volatility? No. Random volatility doesn't stop exactly at round numbers and reverse cleanly. Panic selling? No. Panic creates liquidation cascades that blow through support levels. What creates that pattern is institutional accumulation meeting temporary supply. Here's what I think happened. Some large holder, could be a hedge fund that's been long from lower levels, could be an institutional portfolio that hit rebalancing limits, decided to take profits or reduce exposure. They entered a large sell order, maybe 5 million ounces across futures and ETFs. They weren't trying to crash the market. They were just executing a planned sale. That selling pushed price down from 5,100 to 4,900. At 4,900, the buyers who've been waiting for a pullback entered aggressively. Sovereign wealth funds, Asian central banks, except China, who was on holiday. Family offices, maybe even some of the same hedge funds who sold, just building new positions at better levels. The supply got absorbed in hours. Price stabilized. The crisis was over. Commerzbank looks at this and says, technical and flow factors, volatility, consolidation expected. I look at this and say, the 4,900 level is incredibly well supported. Any dip below 5,000 gets bought immediately. This is a spring loading for the next move higher. Now let's address Commerzbank's concern about U.S. consumer price data. They write, U.S. consumer prices are due to be published today. If these also turn out to be stronger than expected, this would further dampen expectations of interest rate cuts, which could put further downward pressure on gold and silver. This is the standard institutional framework for gold. Gold goes up when interest rates are falling. Gold goes down when rates are rising or staying high, and it's been wrong for the last 12 months. Gold went from 2,800 to 50.42, while interest rate expectations moved higher, not lower. The Fed didn't cut rates. In fact, real rates stayed positive, and gold rallied anyway. Why? Because the drivers of this gold bull market have nothing to do with interest rates. They have everything to do with sovereign balance sheet stress requiring gold revaluation, central bank de-dollarization, accelerating currency debasement across all major fiat systems, geopolitical fragmentation, creating demand for neutral reserve assets. None of those drivers reverse if US CPI comes in at 3.5% instead of 3.2%. So when Commerzbank says stronger inflation data could put further downward pressure on gold, they're applying an outdated framework to a new reality. Higher inflation should be bullish for gold, not bearish. It confirms the currency debasement thesis. It validates the reason central banks are buying. The only way higher inflation is bearish for gold is if it forces the Fed to hike rates so aggressively that they crash the economy and trigger deflation. And even in that scenario, gold would initially sell off, but then rally as the crisis unfolds and the Fed is forced to cut and print. There's no scenario where gold goes into a sustained bear market while US debt is 36 trillion, deficits are 2 trillion annually, and central banks are buying at record pace. Here's what Commerzbank's analysis reveals about institutional thinking right now. They're still analyzing gold as a commodity driven by technical factors and interest rate expectations. They're not analyzing it as a monetary asset being revalued because the fiat currency system is failing. That difference in framework leads to completely different conclusions. From the commodity framework, gold dropped on technical selling, inflation data might pressure it more, expect consolidation. From the monetary framework, gold pulled back 2% after rallying 80% in 12 months. Buyers absorbed the selling at 4,900. Any further dips will be bought aggressively by central banks and sovereign funds who are structurally underweight. Which framework is correct? Look at what's actually happening in markets. Central banks bought record amounts of gold in 2024 and 2025. They've stated publicly that 95% expect holdings to increase in 2026, 0% expect holdings to decrease. China just revealed they've been accumulating for years, hiding the real size of their reserves from the market. BRICS nations are building a gold-backed settlement system for trade outside the dollar. The Eurozone is in crisis. The US debt ceiling fights are becoming more dangerous. Japan is trapped in a debt spiral. Does any of that sound like a technical consolidation story? Or does it sound like a structural monetary transition where gold is being repriced from commodity to currency reserve? Commerzbank is using the wrong lens. That's why their analysis feels disconnected from reality. Let me show you what the price action is actually revealing about market structure. Gold went to 4,900. That's a 6% pullback from the recent highs around 5,200. In the old framework, a 6% drop would trigger technical selling, stop losses, and potentially cascade into a 10 or 15% correction. That didn't happen. Gold stabilized at 4,900 almost immediately and bounced back above 5,000. Why? Because there's massive institutional buying interest at these levels. Every dip gets absorbed. You can see this in the futures market. Open interest didn't collapse during the sell-off. Volume was elevated but not panicky. The COT data, commitment of traders, will likely show commercial buyers adding to positions. You can see it in ETF flows. PSLV and GLD didn't see massive redemptions. Some outflows, sure, but not liquidation. You can see it in physical markets. Premiums for allocated gold didn't spike, which would happen if everyone was rushing to convert paper to physical. The market remained orderly. All of this tells you the 4,900 drop was a managed rebalancing event, not a crisis. Some large holders sold, other large holders bought. Price adjusted down, found support, stabilized. Commerzbank calls this volatility and warns about further downside. I call this a healthy consolidation that's setting up the next leg to 5,400, 5,800 beyond. Now let's talk about the Chinese New Year factor that Commerzbank mentioned. Chinese participants are absent from markets during the holiday period. This is significant for gold because China is the largest physical gold buyer globally, not just the central bank. Retail investors in China buy massive amounts of gold jewelry, coins, and bars, especially around New Year when gold is traditional gifting. When Chinese buyers are absent, physical demand drops. That removes a major source of buying pressure that normally supports prices. So it's not surprising that gold pulled back during this period. The biggest buyer stepped away from the market temporarily. But here's what Commerzbank doesn't tell you. What happens when Chinese buyers come back? They return to a market where gold is 4,900 to 5,100 instead of 5,200 to 5,400. They see a discount, they see an opportunity, and they buy. We've seen this pattern play out every year during Chinese New Year. Gold consolidates or dips while Chinese markets are closed. Then it rallies when they reopen and buyers flood back in. If you understand this seasonal pattern, the current consolidation isn't concerning, it's predictable, and it's setting up the post-holiday rally. Commerzbank mentions this as context, but doesn't draw the obvious conclusion. This dip is temporary and will likely reverse when Chinese markets reopen. That's not bearish, that's a buying opportunity. Here's what I'm watching to confirm that this consolidation is healthy accumulation rather than distribution. Volume profile. I want to see higher volume at lower prices, 4,900, than at higher prices, 5,100. That confirms buyers are stepping in more aggressively as price drops, which is bullish. If volume is higher on the rallies than the dips, that's distribution. Sellers using rallies to exit, bearish. COT data. When the next commitment of traders report comes out, I want to see commercial traders, typically the smart money and commodity markets, adding to long positions during this dip. If commercials are reducing longs or adding shorts, that would be a warning sign. Physical premiums. If premiums for allocated gold or delivery premiums spike above historical norms, that tells you physical buyers are getting nervous and paying up for actual metal. bullish for physical, potentially bearish for paper. If premiums stay stable or compress, that confirms the sell-off was paper-driven and not reflecting physical market stress. ETF flows. I want to see PSLV and FWICE, the Sprott physical trusts, either holding steady or seeing inflows during weakness. That shows sophisticated buyers accumulating. If we see large sustained outflows from physical-backed ETFs, that would indicate real fear and potential further downside. So far, none of these warning signs are present. The consolidation looks healthy. Let me address the inflation data concern directly with some context Commerzbank is missing. They worry that stronger than expected CPI will dampen rate cut expectations and pressure gold. But here's what actually happens when CPI comes in hot. Immediate reaction. Gold might dip as algorithms sell on the higher rates, most bearish for gold narrative. This could last hours or a day. Secondary reaction. Investors realize that persistent inflation confirms currency debasement, which is bullish for gold. Buying resumes. Tertiary reaction. If inflation stays elevated for months, the Fed faces an impossible choice. Keep rates high and break the economy, or cut rates despite inflation and accept currency debasement. Either scenario is bullish for gold long term. We saw this exact pattern in 2021-2022. CPI printed 7, 8, 9%. Each hot print initially pressured gold, but then gold recovered because the implications were obvious. The Fed couldn't fight inflation without destroying the economy. Fast forward to today. CPI is still above 3% despite the Fed's best efforts. The path back to 2% is unclear. And meanwhile, deficits are growing, debt is compounding, and fiscal policy is adding stimulus. So if CPI comes in at 3.5% tomorrow, my reaction is, good. That confirms the thesis. Any dip is a buying opportunity. Commerzbank's reaction would be, uh-oh, rate cuts are delayed, gold might go down. Same data, opposite conclusions, because we're using different frameworks. Here's the practical action plan based on what we're actually seeing in markets, not what Commerzbank is telling us to expect. If you own zero gold, this 4,900 to 5,100 range is an entry opportunity. Don't wait for further downside that might not come. Start with a 5% allocation. If it drops to 4,800 or 4,700, add another 2 to 3%. If you own some gold, 5-10%, hold. This consolidation is exactly what you want to see. It's building the base for the next move higher. If you've been waiting to add more, any test of 4,800 is a gift. If you're overweight gold, 20% plus, don't panic. Don't let a 6% pullback shake you out of a position that's up 80% in 12 months. If you want to rebalance, trim small amounts on rallies above 5,200, not during consolidations at 5,000. If you're trading gold, respect the 4,900 support. That level has been tested and held multiple times. It's now a clear line in the sand. If it breaks convincingly below 4,850, that changes the technical picture. Until then, assume dips get bought. Let me end with the bigger picture that Commerzbank's analysis completely misses. Gold is not consolidating because of technical factors and flow dynamics. Gold is consolidating because it just rallied from 2,800 to 5,400 in 12 months, and every bull market needs to rest before the next leg. The consolidation at 5,000 is healthy. The dip to 4,900 shook out weak hands. The stabilization above 4,900 confirmed strong support. What happens next? Chinese buyers return from holiday. Physical demand resumes. Central banks continue systematic accumulation. Sovereign wealth funds execute allocation increases approved in February, and gold breaks 5,000 cleanly, makes a run at 5,400, and sets up for the eventual move to 6,500 and beyond. Commerzbank sees volatility and warns about downside risks. I see a coiled spring getting ready to launch, same price action, completely different interpretation, and the interpretation that aligns with the fundamental drivers, sovereign debt, currency debasement, de-dollarization, central bank buying, is the one that's going to be right, not the interpretation based on outdated commodity frameworks and interest rate correlations. Commerzbank says, volatile slide, then consolidation expected. They're right about the consolidation. They're wrong about what it means. This isn't gold losing momentum. This is gold building the foundation for the next major leg higher. The banks will keep publishing cautious analysis warning about technical factors and downside risks. The central banks will keep buying. The sovereign funds will keep allocating. The fundamentals will keep deteriorating. And gold will keep doing what it's done for 5,000 years. Outlasting every currency, surviving every crisis, repricing higher as the monetary system transitions to a new equilibrium. Commerzbank can call it volatility if they want. I'm calling it opportunity, position accordingly.